Hello guys, welcome back once again to the Financial Academy YouTube channel. Yes, of course. Welcome back once again to the Financial Academy YouTube channel. So, in today's video episode, I'm going to be teaching you how to start forex trading as a complete beginner. Yes, of course. In today's video episode, I'm going to be teaching you how to start forex trading as a complete beginner. So, if this thing is what you like, how I do is I create content on forex trading, stock trading, and cryptocurrency trading. So please make sure to like this video, give it a thumbs up, comment the video, subscribe to my YouTube channel, and also comment down below if you have any single question concerning any of my single videos. Are you getting me? So many people on the internet are searching for a complete beginner's guide, on how to start their forex trading journey. So in today's video episode, this video is dedicated for all the beginners who want to venture into the business of forex trading. Understand? But you have to know one thing in mind. Forex is not a get rich quick scheme. Are you getting me? So without further ado, I will take you down to my screen. When I take you down to my screen, I'll be able to, break down for you everything you need to know as a beginner who want to start forex trading journey. Are you getting me? So follow me right now. Let's get down to the video. Please, before then, make sure you like this video. Make sure you subscribe to my YouTube channel and also comment down below if you have any simple question concerning this video. So let's get to my screen right now. Let's go. Let's go.
Hello guys, welcome to my screen. So, introduction to the forex trading, a complete beginner's guide. Yes, of course. These are the complete beginner's guide if you are being new to the forex market. Are you getting my point right now? Let's continue. Forex trading is one of the most talked about ways people try to make money online today. You may have seen flashy videos on social media, heard stories of people turning small accounts into big profits, or even being invited to learn forex by a friend. But what exactly is forex trading? How does it really work? And is it as easy or as risky or as people may think it's as it sounds? In this video, we will break down in simple language without hype or confusion. By the end of this video, you will clearly understand what forex trading is, how the market works, why people trade it, and the difference between forex myths and reality. I get my point. Let's continue. What forex trading really means. Forex is short form of foreign exchange. Forex trading simply means buying one currency and selling another one at the same time, with the goal of making profit from the changes in their value. Every country has its own currency. I get my point. The United States uses the US dollar. The United Kingdom uses the Great British Pounds. The Europe uses the Euro. And the Japan uses the Japanese yen. So every country have their own currencies. I get my point. Then forex trading happens when people exchange one currency for another. For example, exchanging US dollar for euro, exchanging British pounds for Japanese yen. In forex trading, currencies are traded in pairs such as euro USD or euro versus USD, GBP USD or GBP British pound versus USD. Then you have USD JPY, which is US dollar versus Japanese yen. Are you getting me? In forex trading, currencies are traded in pairs. Understand this very well. When you trade forex, you are speculating. Will one currency increase in value or will it decrease compared to another currency? So whenever you are trading, you are speculating in the forex market. You are speculating whether this currency will increase in value or will it decrease compared to another currency. I get my point. If your prediction is correct, you will make profit. If it is wrong, you will take a loss. Are you getting me? So at its core, forex trading is not gambling. It is analyzing price movement and making informed decisions, though it carries risk. How the forex market works, because you need to learn and understand how the forex market works, because the forex market is the largest financial market in the world. Yes, trillions of dollars are exchanged every single day. Number one, a global decentralized market. Unlike the stock market, forex has no central location or physical exchange. It operates electronically through banks, financial institutions, brokers, and individual traders. Are you getting me? This means that forex trading happens all over the world across different time zones. Number two, the market runs 24 hours a day. Yes, forex operates 24 hours a day, 5 days a week, because one major market closes, another market opens. The three main trading sessions that we have three trading sessions that we have. The main three, we have the Asian session, we have the London session, and we have the New York session, because this allows traders to participate at almost any time depending on their schedule. Number three is currency pair and price movement. Each currency pair has a base currency, which is the first one, and a quote currency, which is the second one. Let me give you an example. Euro USD is at the price of 1.100. It means that 1 euro is worth $1 10 US dollar. Is worth $1 10 cents US dollar. So if the price move up, the base currency is strengthening. But if the price moves down, the base currency is weakening. I get my point right now. So trader aims to buy when they believe the price will go up and sell when they believe the price will go down. Are you getting me? Let me repeat again. Traders aim to buy when they believe that the price will go up, and they sell when they believe the price will go down. You need to ask yourself this question: why people trade forex, or why do you want to trade forex? People trade forex for different reasons, and understanding this reason helps separate genuine opportunities from false promises. Opportunity to make money. The most obvious reason is profit. Price movements happen daily, creating opportunity for traders to earn money if they understand the market. Number two is accessibility. Forex trading is one of the most accessible financial markets. You can start it with a relatively small amount. You only need a phone or computer and internet. You can trade from almost anywhere in the world. Number three is high liquidity. Yes, high liquidity. Because forex is so large, trades can usually be entered and exited quickly without delay. This makes it attractive to many traders. Number four is flexibility. Forex trading can be full-time, part-time, or something you learn slowly while doing other work. I get it. Many people like that because they are not tied to one location or fixed hour. Number five is learning financial skills. Yes, forex trading teaches you valuable skills such as risk management, discipline, market analysis, and emotional control. Are you getting me? Even traders who doesn't succeed immediately often get useful financial knowledge. Let me now tell you the myth versus reality about forex trading. Yes. Number one of the biggest problem in forex trading is misinformation. But let me clear up some of the common myths. The number one myth is this: forex trading is a get rich quick scheme. But the reality is this: forex is not a shortcut to wealth. Successful traders usually spend months or years learning, experience losses before consistency, focus on risk management, not fast money. Anyone promising guaranteed profit is misleading you. I get my point. Learning for this video. The second myth is this: you need a lot of money to start. But in reality, you don't need huge capital to learn forex. Many traders start small to practice and gain experience. What matters more than money is your knowledge or discipline and patience. Are you getting me? The third myth is forex trading is pure gambling. But in reality, while forex involves risk, it is not random gambling. Professional traders use technical analysis, fundamental analysis, and risk management strategies. However, trading without knowledge or trading without knowledge or plan turns it into a gambling. Are you getting me? Then, myth 4, forex trading is easy. But in reality, forex trading is simple to understand but hard to master. Emotional control, consistency, and discipline are bigger challenges than placing trades. Myth 5 is everyone who trades forex loses money. In reality, not everyone loses money, but many beginners do because they rush the learning process. They risk too much and follow hype instead of strategy. With proper education and realistic expectation, some traders do achieve long-term success. Then my final thought on this section is this. Forex trading is powerful financial market that allows people to trade global currencies and potentially earn profit. However, it is not magic, not guaranteed, and not effortless. Understanding what forex trading really is, how the market works, why people trade it, and separating myth from reality is the first and most important step for any beginner watching this video. Before thinking about profit, focus on learning, patience, and risk awareness, because forex reward discipline more than excitement. So if you take forex as a skill to develop, not a shortcut to riches, you are already ahead of the most beginners. Are you getting me? Now, basic forex terminology you must know, a complete beginner's guide. Before you place your first forex trade, there is one thing you must do: understand the language of forex. Yes, many beginners lose money not because forex is impossible, but because they trade without understanding the terms like pips, lots, spread, or leverage. Forex has its own vocabulary, and once you understand it, everything else starts to make sense. In this video, or in this section, we will break down the most important forex terminologies every beginner must know, and we explain it in simple words with real life example and no confusing jargon. Number 1, currency pairs. Under currency pairs, we have the major currency pair, we have the minor currency pair, and we have the exotic currency pair. So in currency are never traded alone. No, they are traded in pairs. This is because when you buy one currency, you are automatically selling another one. What is a currency pair? A currency pair shows you the value of one currency compared to another. Example, Euro USD, it means Euro versus USD. If Euro USD is trading at 1.10, it means 1 euro equals to $1.10 in US dollars. Types of currency pairs. Number 1, we have major currency pairs. Major pairs are the most traded currency pair in the world. They always include the US dollar, which is the USD, and currency from strong economies. Here are the list of major currency pair example. These are the Euro USD, the GBP USD, the USD JPY, the USD Swiss francs, and the AUD USD. Why beginners like major currency pairs? Number 1 is because low trading costs. Number 2 is that because it has more stable price movements. And number 3 is because it has plenty of market information. Then let's switch to number 2, minor currency pairs. Minor pairs do not include the US dollar, but they are still involved in major world currencies. Are you getting me? Example, the Euro GBP, the Euro AUD, and the GBP JPY. They are traded less than the major currency, but they are still popular among traders. Then we have the number 3, which is the exotic currency. Exotic currency pairs include one major currency and one currency from a developing or smaller economy. Example, we have the US dollar Nigerian naira, we have the US dollar South African rand, and also we have the euro versus the Turkish lira. Are you getting me? But important note for beginners, exotic pairs usually have high cost and more unpredictable movement. They are not ideal for beginners. These are ideal for experienced traders, but not for beginners who are starting out in forex trading. So begin with the major currency pair. Are you getting me? Then we have the base currency versus world currencies. So let's continue from the next section. Every currency pair has two currency, and each of them has one specific role. Example, Euro USD. Base currency is the first currency in the pair. It is the currency you are buying or selling. In Euro USD, Euro is the base currency. Quote currency is the second currency in the pair. It tells you how much of it is needed to buy 1 unit of the base currency. Are you getting me? So in Euro USD, USD is the whole currency. Simple explanation of this is this. If the Euro USD is equals to 1.100, it means that 1 euro costs you $1 10 cents in US dollars. Are you getting me? When price goes up, the base currency is getting stronger. When the price goes down, the base currency is getting weaker. Are you getting me? Then we have pips, points, and lot size. These are some of the most important concepts in Forex. They are directly affect profits and losses. So what is pips or what is a pip? A pip simply means percentage in point. It's the smallest price movement in most currency pairs. Example, Euro USD moves from 1.10 to 1.1001. The movement is 0.001 equals to 1 pip. If price moves from 1.100 to 1.1010, it means that the market has moved by 10 pips. Pips are how traders measure their profit and loss. So what is a point? A point is often a smaller movement than pips, usually the last decimal that is shown by your broker. Example, if a price moves from 1.10001 to 1.10002, it means that 1 point, that means 1 point and not 1 pip. Think of it like 1 pips equals to 10 points in most cases. Are you getting me? Then let's continue. What is a lot size? A lot size refers to the size of your trade, how much currency you are buying or selling. There are different types of lot size. We have standard lot, which is the 100,000 units of the currency, of the base currency. We have mini lot, which is the 10,000 units of the base currency. And we have micro lot, which is 1,000 units of the base currency. We have nano lot for some brokers that have it, which is 100 units of the base currency. So why do this matters? The bigger your lot size, the more money you can make, but the more money you can lose. Are you getting me? For beginners, micro or nano lot size are safest. Spread, commissions, and swap. Let's go over to another subtopic. These are the costs associated with trading. Are you getting me? Spread. What is the spread? The spread is the difference between the buy price, which is the ask, and the sell price, which is the bid. Are you getting my point? Example, when you buy 1.1002 and you sell at 1.100, the spread is 2 pips. This is how most brokers make money. They make money through commission. Some broker charges a commission instead of an addition to spread. So it is usually a fixed fee per trade, often seen on professional or ECN accounts. Then swap or overnight fees. A swap is a fee charged or sometimes paid when you keep a trade open overnight. It depends on the interest rate between different currencies, direction of your trade, buy or sell. Are you getting me? Beginners often ignore swap, but they matter for long-term trades. Then let's talk about leverage and margin. Let me explain this in simple terms. It is one of the most misunderstood area of forex, and also one of the most dangerous if not understood properly. What is leverage? Leverage allows you to control a large trade with small amount of money. Example, 1:100. It means that with $100, you can control 10,000 equity of money. So leverage magnifies your profits. At the same time, it magnifies your losses. This is why it must be used carefully. Are you getting me? What is margin? Margin is the amount of money your broker locks to keep your trades open. Think of margin as a security deposit and not a fee. If your trade goes against you too much and your account balance drops, your broker may close your trade automatically. It is called margin call. Then, simple analogy. Leverage is like borrowing a loudspeaker. It makes your voice louder, but if you say the wrong thing, it damages louder too. So use wisely, leverage use usefully, use carelessly, it can wipe out an account quickly. My final thought on this section is this. Understanding forex terminology is not optional, it is essential. Once you understand currency pairs, pips and lot size, spread and leverages, you stop trading blindly and start trading with clarity and control. Forex doesn't start with strategy or indicators. It starts with understanding the basics. Master these terms and every future lesson will come make more sense. Are you getting my point right now? So right now, you need to ask yourself how the forex market operates. A complete beginner's guide. One of the biggest reasons forex confuses beginners is not because it is too complex, no, but because people don't understand how the market actually runs. Yes. The question is this: who decides forex prices? Why does the market move at a certain times? Or is forex open all day? These are very normal questions you need to ask yourself. So in this guide, you will learn how the forex operates behind the scene, including trading session, market hour, and who really control forex and why prices move the way they do. Now let's talk about the trading session. In trading, we have four sections in trading. We have the London session, we have the New York session, we have the Tokyo session, and we have the Sydney session. The forex market operates 24 hours a day, but it does not move the same way all the time. This is because different parts of the world trade different times. Forex trading is divided into four major sections, named after the world main financial centers. Are you getting me? We have number one, the Sydney session. It opens the forex week with low volatility and slow price movement. This session is often quiet because major financial centers are still closed. It is mainly active for currencies like Australian dollar and the New Zealand dollar. Then number two, we have the Tokyo session, which is the Asian session. It has moderate volatility, important for Asian currencies. The key currencies traded are the JPY, Japanese yen, Aussie dollar, and the New Zealand dollar. Price movements are usually steady, not aggressive. Many beginners prefer this session because it is calmer. It is calm. Then you have the third one, which is the London session, which is the European session. The most active forex session. High volatility, strong price movements. The London session is extremely important because it overlaps both Asian and New York session. A large portion of global forex volume flows through London session. Most major currencies pair are seeing strong moves during this time. Then the fourth one is New York session. It has a high volatility, strong price movement, especially early in the session. This session overlaps with London for several hours, creating the most liquid and volatile period of the Forex day. Major economic news from the United States is often released during this session, causing sharp price movements. Are you getting me now? Now let's talk about the market hours and the best time to trade. Forex market hours. The Forex market runs 24 hours in a day, 5 days in a week. It opens on Monday and closes on Friday because the market follows the global time zone. Trading never truly stops during the week because best time to trade, because not all hours are equal. Sometimes offer, because if all hours are equal, every trading session must be equal, but not all hours are equal. Sometimes offers better price movement. Yes, some trading sessions offer better price movement, lower trading cost, and more trading opportunity. Best trading period, which is the best time to trade, is during the London session and the London and the New York overlap. Overlap simply means when the London session and the New York session are trading at the same time, there are too much volume and there are too much transaction going on during those periods, and there is a high liquidity, which is the high amount of money that is flowing in that period. So you are meant to and advised to trade during London session and during overlap session. So during these times, liquidity is high, which I've already explained, spread are low, and trends are clear. Worst time to trade is this: market opening on Monday and market closing on Friday, and also during major holidays. These are the worst time to trade. This period often have low liquidity and unpredictable movement. You need to know this and understand who controls the forex market. It's a very important question you need to ask yourself. Who controls the forex market? One of the biggest misconceptions is that one person or company controls the forex. No, it is not true. Forex has no central authority. Unlike the stock market, forex is decentralized. There is no headquarter, there is no single controller, and there is no single exchanger. Are you getting me? Instead, forex operates through a global network of participants. The major participants in the forex market is one, the central banks, because the central banks are the most powerful players in forex. They influence currency value by changing their interest rate, controlling their money supply, and intervening in the market when needed. Examples of these are the Federal Reserve in the United States, we have the Bank of England, and the European Central Bank. Number two is commercial banks. Large banks trade huge volume daily, both for their own profit, client, and corporation. They provide liquidity to the market. Yes. Third one is financial institutions and hedge funds. These institutions trade large amounts and often move the market significantly. Then we have number four, corporation. International company exchanges currency for importing and exporting goods, paying employees abroad, and global operations. Then we have retail traders, you and me. Retail traders make up a small portion of the market, but collectively add liquidity and activity. Why prices move in forex? You need to ask yourself this question: why prices move in forex? Forex prices does not move randomly. They move because of supply and demand driven by real world factors. Yes, they move because of supply and demand driven by real world factors. One, economic news and data. Economic reports have a major impact on currency value. Example, interest rate decision, employment reports, inflation data, and GDP reports. Positive news usually strengthens a currency. Negative news weakens it. Number two is interest rates. Currencies with higher interest rates tend to attract more investors, increasing demand and pushing price higher. Number three is political event and stability. Election, war, government policies and political uncertainty can cause strong price movements. Stable currencies usually have a stronger currencies. Are you getting me? Then number 4, market sentiment. Sometimes price moves simply because traders expect it to move. Fear or confidence spread. This collective philosophy psychology helps helps sorry this collective psychology plays a big role in forex. I get my point. Then what about the supply and demand? At the simplest level, more buyers than seller, price go up. More sellers than buyer, price go down. Are you getting me? So if there are more buyer than seller, the price go up. And if there are more sellers than buyer, the price go down. Are you getting me? So every candle on a forex chart reflect this battle. Are you getting me? So my final thought on this section is this. The forex market may seem complex at first, but once you understand how it operates, everything becomes clearer. The key takeaway is this. Forex run 24 hours because of the world trade in different time zones. London and New York session offer the best opportunity for you to trade. Then no single person controls the forex market. Prices move due to economic, political, and psychological factors. Then forex is not a chaos. It is an organized global system reacting to real world events. Once you understand how the market operates, you stop guessing and start trading with awareness. Are you getting me? Choose the right forex broker. Choosing the right forex broker, a complete beginner's guide. So this is the next topic that I'm telling you in this video. Choosing the right forex broker. Before you ever place a trade in the forex, there is one decision that can make or break your trading journey, which is choosing the right forex broker. Many beginners focus on strategies and indicators, but forget something even more important: the broker. A good broker protects your money, gives you fair prices, and allows smooth trading. A bad broker causes losses even when your analysis is correct. This guide explains what forex broker do, how to tell the difference between regulated and unregulated brokers, what to check before signing up, and common mistakes beginners make. Let's continue. What a forex broker does. A forex broker is a company that gives you access to the forex market. Are you getting my point? Because the forex market is because the forex market is decentralized and extremely large, individual traders cannot trade directly with banks or institutions. Brokers act as the middleman between you and the market. So what a broker provides is this: a trading platform like the MetaTrader, access to currency pairs, real-time price charts, real-time price movements, trade execution, which is your buying or selling execution, and account management and withdrawals. Without a broker, you simply cannot trade forex as a retail trader. Regulated versus unregulated brokers. This is one of the most important things ever beginner must understand. What is a regulated broker? A regulated broker is supervised by an official financial authority. This authority ensures that the broker follows strict rules designed to protect traders. Are you getting me? Regulated broker must keep client funds separate from company funds, follow fair trading practices, allow transparent withdrawal, and submit regular audits. Examples of regulated authorities are the FCA in the United Kingdom, the ASIC in Australia, the Cyprus SEC, and the NFA or CFTC in the United States. What is an unregulated broker? An unregulated broker operates without oversight from an organized financial authority. This means that no guarantee your money is safe, no external body to report if issue arises, and higher risk of manipulation or withdrawal problem. Some unregulated brokers are not scam, but many scams operate these ways. Which is better for beginners? For beginners, regulated brokers are always safer. Even if trading conditions are slightly stricter, the protection and peace of mind are worth it. Are you getting me? So I would advise you to go for regulated brokers. Things to shake before signing up with a broker. Choosing a broker should never be rushed. Here are the key things every trader should shake before opening an account. Regulation and license. Always shake who regulates the broker, whether the license number is real. A broker that hides its regulation details is a red flag. Yes, of course. A broker that hides its regulation details is a red flag. Know this. Number two, trading platform. Most brokers offer platform like MetaTrader 4 or MetaTrader 5. Make sure that the platform is stable. Make sure that the platform is easy to use, and make sure it is available in mobile phone and in desktop. Do you understand? Then number three is spread and fees. Check the average spread on a major pairs, whether the broker charges commission or whether there is an overnight swap fees. Low spread are good, but extremely low spread can sometimes indicate poor execution. Then number four, leverage option. Brokers offer different leverage level for beginners. Lower leverage is safer. Extremely high leverage increases risk. The other one is choose a broker that allows you to control or reduce leverage. Deposit and withdrawal method, which is number five. Check if your broker supports bank transfers, cards, or local payments. Important in many countries. Are you getting me? Also check your withdrawal speed, and also check if there is any hidden withdrawal fees. Number six is customer support. Customer support matters more than beginners realize. Look for live chat, email or phone support. Also look out for fast response time. Poor support can become a serious problem when issue arises. Are you getting me? Then let's talk about demo account versus live account. Before risking any real money, every beginner should understand the difference between demo and live account. Demo account uses virtual money and not real funds. What are the benefits of demo account? Practice trading, learn the platform, test strategy, make mistake without losing money. A demo account is like a training ground. A live account uses real money. This introduces you with real emotion, real risk, and real profit or loss. Many beginners fail because they jump into live trading too quickly. The best approach for beginners is this: start with a demo account, practice until you understand how trades work, then move to a live account with small capital. Common beginners mistake when choosing broker. Avoid this mistake. Yes, it can save you time, money, and stress. Number one is this: choosing a broker based on bonuses. Big bonuses often come with hidden condition and withdrawal restriction. Bonuses should never be main reason you choose a broker. Ignoring regulation. Some beginners skip regulation because the broker looks professional. Someone recommended it. This is extremely risky. Number three is using extremely high leverage. High leverage looks attractive but amplify losses. Wipe account quickly if you're not careful. Beginners should focus on learning and maximizing risk. Number four is not testing the broker first. Many beginners skip demo testing and go straight to live trading. This leads to platform confusion, execution mistake, and emotional losses. Number five is following social media hype. Just because a broker is popular on social media doesn't mean it is reliable. Always do your own research. It is very, very important. Then my final thought on this section is this: choosing the right forex broker is not just a technical step, it is a foundation design. A good broker protects your funds, provides you fair trading condition, and supports your trading journal or support your trading journey, your learning journey. A bad broker can destroy even the best trading strategy. As a beginner, focus on safety, regulation, transparency, and simplicity. Forex trading is already challenging. Your broker should make it. Your broker should not make it harder. I get my point. Now let's talk about forex trading platform. Explain. Once you choose a forex broker, the next thing you will hear about is trading platform. For many beginners, this is where confusion begins. You may ask, what exactly is a trading platform? Why are there different platforms like MT4 and MT5? And also, how do I actually place a buy or sell trade? So this guide explains everything in terms of in simple terms, so you can confidently open a trading platform, understand what you really see, and know how trade are placed. I get it. So what is trading platform is? A forex trading platform is a software or application that allows you to place to trade currencies through your broker. Think of it as your control center for trading. The place where you see the price chart, where you place your buy and sell orders, and also where you manage open trade and profits. Without a trading platform, you cannot interact with the forex market, even if you have a broker account. What a trading platform allows you to do is this. A forex trading platform lets you to view live currency prices. It lets you analyze charts. It lets you place buy and sell trade. And also it lets you set stop loss and take profit level. Also it helps you monitor profit and losses. And also it helps you manage your account. In short, the platform is where all trading activity happens. Popular trading platforms like MT4, MT5 and others. Why are there many platforms available? A few dominate first world. So the popular ones are the MT4 and MT5. Understand? Even though we have so many others, but the popular ones are the MT4 and MT5. MetaTrader 4 or MT4 is the most popular forex trading platform, especially among beginners. Why MT4 is popular is this. One, it is simple and easy to use. It is designed mainly for forex, and it works well on a low-end device. Also, it has large online community and tutorials. For many beginners, MT4 is the easiest platform to start with. Then we have MT5, which is a MetaTrader 5. The MT5 is newer version of MetaTrader, but it is not just an upgrade. It is slightly different. The key difference is this: it supports forex, stocks, and other assets. It has more time frame and more technical indicators. Some beginners prefer MT5, but it can feel more complex at first. Other trading platforms, some brokers use their own custom platform or web-based platform. This may look more modern, more easier to use on browser, and has fewer advanced features. As a beginner, what matters the most is simplicity, stability, and reliability. Are you getting me? Now let's talk about the basic platform features every beginner should know. When you open a trading platform for the first time, it can look overwhelming. Let's break down the core features you will see at almost every forex platform. One is Market Watch. This section shows available currency pairs, live prices, and bid and ask prices. This is where you choose what currency pairs to trade. Are you getting me? Then number two is chart window. The chart window is the price movement over time, candlestick or lines, and market trends. You can change time frame from 1 minute, 5 minutes, 1 hour, etc. You can change the chart type, and also you can change your indicators. Chart helps you analyze the market before trading. Number three is order windows. This is where you choose your lot size, set your stop loss and take profit. Also, buy or sell a currency pair. This window is crucial. It is where trades are executed. Number four is trade or terminal section. This area shows open trade, profit or loss, account balance, or margin level. It helps you monitor everything happening in your account. Then number five are indicators and tools. Indicator help traders analyze price movement. Example, moving averages, RSI, MACD. As a beginner, start simple. Too many indicators can cause confusion. Are you getting my point? So you need to start simple as a beginner and avoid too many indicators to avoid confusion. Then, how to place a buy or sell trade is step by step. Placing a trade may sound intimidating, but once you understand the steps, it becomes straightforward. Step 1 is choose a currency pair. From the market watch, select a pair like Euro USD or GBP USD. Step 2, decide buy or sell. Buy if you believe the price will go up, and sell if you believe the price will go down. That is it, no complication. Step 3, select your lot size. Choose how big your trade will be. For beginners, use micro or nano lots. Keep risk small. Lot size control how much you gain or lose per price movement. Step 4, set stop loss and take profit. Optional but recommended. Take profit limit how much you can lose. Stop loss limits how much you can lose. And take profit, lock in profit whenever it reaches the target. Using this protects you from emotional decision. Step 5 is place the trade. Click buy to enter a buy trade and click sell to enter a sell trade. Your trade is now live. Step 6, monitor and manage your trade. You can close the trade manually, adjust stop loss or take profit, and let the trade close automatically. All of this happen inside the platform. Are you getting me? Now, common beginners platform mistakes to avoid. Number 1, trading without understanding the button. Using large lot size too early. Forgetting to set stop loss. Overloading charts with indicators. And trading on a live account without practicing on demo. My final thought on this section is this. A forex trading platform is not something to fear. It is simply a tool like any tool. The more you use it, the more comfortable you become. So as a beginner, focus on learning the platform, practice on a demo account, and keep things very simple. Are you getting my point right now? Then mastering the trading platform is a major step forward to becoming a confident forex trader. Are you getting me? So let's head over to the next topic, which is understanding forex chart, a complete beginner's guide. When most beginners open a forex trading platform for the first time, the chart is what scares them the most. Candle moves up and down, strange shapes, different time frame, and it can look confusing and intimidating. But here is the truth. A forex chart is simply a visual record of price movement over time. Once you understand how the chart looks, they stop being scary and start becoming your most powerful trading tools. So this guide explains everything you need to know about forex chart in simple clear language, from chart types to candlestick, time frame, and support and resistance. Types of forex chart: we have line chart, we have bar chart, and we have candlestick chart. Understand? So trading platform offer different ways to display price movements. These are called chart types. Understand? So number 1, we have line chart. A line chart is the simplest type of trading chart. It shows a single line connecting the closing price. It ignores detailed price movements, and it gives a clear overview of direction. Are you getting me? And it is best for seeing overall trend. Also, it is best for absolute beginner who want simplicity. Are you getting me? But the limitation is this: it lacks detailed price information. Number 2, we have bar chart. A bar chart provides more information than a line chart. Each bar shows open price, closing price, highest price, and lowest price. While informative, bar charts can look confusing for beginners. Then number 3 is candlestick chart, which is the most popular one. Are you getting me? Candlestick charts are the most popular and widely used chart in the forex trading. Why traders love candlestick is because 1, it is easy to read visually. it shows emotion and momentum, and it reveals market behavior clearly. Are you getting me? So most forex education focuses on candlestick chart for a good reason. Are you getting me? So we'll be focusing on candlestick chart. How to read candlestick. Understanding candlestick is one of the most important skill in forex. Part of a candlestick. Each candlestick represents price movement during a specific time period. A candlestick has body, which is the open and close price. Then it has wicks or shadow, which is the high and low price. Then under that we have bullish versus bearish candle. A bullish candle shows price close higher than it open, usually colored in green or white, showing buying strength. Then a bearish candle does what? Price close lower than its open, usually colored in red or black, showing selling pressure. What candlestick tells you? Candlestick shows who is in control, whether the buyers or seller are in control. Market momentum, rejection and indecision. Large candle shows strong movement. Small candle shows hesitation or consolidation. Time frame explained. From 1 minute to monthly. Let me explain what is time frame. A time frame shows how much time each candle represents. Are you getting me? So common forex time frame are the M1, which is 1 minute per candle. We have the M5, which is 5 minutes per candle. It means that every 5 minutes, if a candle form in 5 minutes time frame. M1 means every 1 minute a candle forms in the 1 minute chart. Then we have M15, which means every 15 minutes a candle forms in the chart. Then we have M30 per candle. It means that every 30 minutes a candle forms on a 30 minutes on a candle a 30-minute chart. Then we have H1, which is 1 hour per candle. We have H4, which means 4 hours per candle. That means every 4 hours a candle forms in a 4-hour chart. Then we have daily candle, which is D1. It means every day a candle form on a daily time frame. Then we have W1, which means every week a candle forms on a weekly time frame. Then we have MN, monthly candle, which means every month a candle forms on a monthly chart. So how time frame affect trading? Lower time frame means faster movement, more noise and higher stress. Higher time frame, one, smoother price action, clear trends and better for beginners. So work more on a higher time frame as a beginner. Then the best time frame for beginners, most beginners do better with 1 hour time frame, 4 hour time frame and daily time frame, because this time frame reduce emotional trading and false signal. Are you getting me? Now let's talk about support and resistance basis. Support and resistance are foundation concepts in forex trading. What is support? Support is price level where price tends to stop falling and bounce upward. Are you getting me? Because it represents a strong buying interest, a price area buyers defend. What is resistance? A resistance is a price level where price tends to stop rising and fall down. It represents a strong selling pressure, a, a price area sellers defend. Are you getting me? Then how to identify support and resistance. At previous high and lows, where the price has reversed multiple times, at psychological levels or round up numbers. Are you getting me? Then you don't draw them as exact line, but you see them as a zone. Are you getting me? So don't see support and resistance level as an exact line. No, see them as a zone or area in the market. Are you getting me? Why support and resistance matter? One, they help traders find entry point. They help traders set stop loss level. They help traders set profit target. And they help traders understand market structure. Most professional traders rely heavily on support and resistance. Common beginner chart mistake is one, using too many indicators. Trading on a very low time frame, ignoring higher time frame, and drawing support and resistance too precisely, and also overreacting to every candle. My final thought is this: every forex chart are not magic. Forex charts are not magic. They are stories of price movement. Every candle represents decision made by buyers and sellers around the world. Once you understand chart types, candlesticks, time frame, support and resistance, stop guessing and start reading the market logically. Are you getting me? Charts don't predict the future, but it helps you to make better decisions. Are you getting me? Now, let me give you another introduction to market forex analysis. How traders decide when to buy and when to sell. So, in this section, one of the biggest questions beginners ask is this: how do traders know when to buy or enter a trade? Are you getting me? The answer is this: forex analysis. Forex analysis is simply the process traders use to study the market and make informed decisions. Instead of guessing, it helps you decide when to buy, when to sell, when to stay out of the market. There are three main types of forex analysis. We have technical analysis, we have fundamental analysis, and we have sentimental analysis. This guide explains each one in simple language, which shows you how they work and help you understand which of them is the best for beginners. What is forex analysis really means? Forex analysis is the method traders use to predict possible price movement based on price behavior, based on economic information, and based on traders' psychology. No analysis method is 100% accurate. The goal is not to be right all the time, but to increase your chances of making good trading decisions. Technical analysis or simple explanation. Technical analysis is the study of price charts and pattern. Instead of asking why the price moves, technical analysis focuses on what the price is doing. What technical analysis uses? Technical analysis is based on one, forex chart. Number two, candlestick pattern. Number three, support and resistance. Number four, indicators like moving average and RSI, etc. The idea is simple. The price movements tend to repeat themselves. Traders study past price behavior to anticipate future movements. Example of technical analysis. If the price has bounced up several times from a certain level, traders may believe buyers are strong at that level. Price may bounce again. This belief influences buy or sell decision. Why technical analysis is popular? One, it works on all time frame. Number two, can be used without news. Number three, easy to practice on demo account. Number four, visual and logical. For many traders, technical analysis is the foundation of forex trading. Yes. We have fundamental analysis, which is new and economic event. Fundamental analysis focuses on economic and political factors that affect currency value. Instead of chart, it looks at real-world events. What is fundamental analysis studies? Fundamental analysis studies include interest rates, inflation reports, employment data, central bank decision, political events, and economic news release. Then we have currency move because currency move because of economic changes. Are you getting me? Examples of fundamental analysis is this: if a country rises in their interest rate, its currency often becomes stronger. Investors are attracted to higher returns. Traders may look to buy that currency. Are you getting me? But there are challenges of fundamental analysis for beginners. Number one, news can be complex. Yes. Market reactions are unpredictable. and also it requires understanding of economics, and also timing trades can be difficult. Fundamental analysis is powerful, but it can be overwhelming at first. Then you have sentiment analysis, which is the market psychology. Sentiment analysis looks at how traders feel about the market. Do you understand me? It answers the question, are traders most it answers the question, are traders most likely buying or selling? Are you getting me? So what sentiment analysis measure is this? Sentiment analysis studies traders positioning, market optimism or fear, and crowd behavior. Markets often move because of human emotion, fear, greed, hope, and panic. Why sentiment analysis matters? When most traders are buying, the market may be overbought, and when most traders are selling, the market may be oversold. Smart traders often look for moments when the crowd is strong. Sentiment analysis is subtle. Is subtle. Sentiment is rarely used alone. It works best when it combined with technical analysis and key price levels. Are you getting me? So sentiment analysis does not work alone. It works based on technical analysis and key price levels. Are you getting me? Then you need to ask yourself which analysis are the best for beginners. This is one of the most important questions traders ask. Best choice for beginners is technical analysis. Technical analysis is generally the best starting point because it is visually and practical, easier to learn step by step, and also can be practiced without real money. Then also helps beginners to understand market structure. I get my point right now. Most successful traders start with technical analysis and expand later. Are you getting me? Then you need to ask yourself when to add fundamental analysis. Once you understand charts, use fundamental to understand the big market moves. Avoid trading during major news if you are unsure, and also learn how news affect volatility. And also learn how news affect volatility. I get my point. Then let's talk about the role of sentiment analysis for beginners. Sentiment helps you to avoid following the crowd blindly. It helps you to avoid market emotion and also helps you, to understand and gain confidence in trade decisions. It should support and not replace other analysis. Are you getting me? So sentimental analysis should support and not replace other analysis method. Are you getting me? Combining the three type of analysis, many traders eventually combine technical analysis for entry and exit, fundamental analysis for direction and volatility, and sentimental analysis for confirmation. But as a beginner, simplicity is key. Are you getting me? Common mistakes beginners make in forex analysis. Number one, trying to learn everything at once, relying too many on indicators, ignoring risk management, and trading every news event. Also, overanalyzing the charts. These are the common mistakes beginners make in forex analysis. Then, my final thought on this is this: forex analysis is not about predicting the market perfectly. It's about understanding probability and managing risk. Start simple. Learn the technical analysis first. Practice consistently. Add fundamental gradually. Observe market sentiment. With time, forex analysis become less confusing and more logical. Are you getting me? Now, let's talk about the basic forex trading strategy for beginners. Simple ways to trade the forex market, which is another part of this video. After learning how forex work, how to read charts, and how to analyze the market, the next big question beginner asks is this: how do I actually trade? Are you getting me? So this is where technical or trading strategies comes in. A forex trading strategy is simply a set of rules that tells you when to enter a trade, when to exit a trade, and when to stay out of the trade, and when to stay out of the market. This introduces simple and proven trading strategies that beginners can understand and practice without confusion. Are you getting me? So what is a trading strategy really? What a forex trading strategy really is? A trading strategy is not magic and not a guarantee of profit. It is a structured plan, a way to reduce emotional trading, and a method to trade consistently. Without a strategy, beginners often enter trade randomly, overtrade, chase losses, and also blow their account. A simple strategy gives you direction and discipline. Trend trading basics. Trend trading is one of the most easiest and simplest strategies for beginners. What is a trend? A trend is a general direction of the market. There are three ways a trend can form. One is an uptrend. The price is moving higher. A downtrend. The price is moving lower. And a sideways means the price is moving in a range between the buying and selling or consolidating. Whichever way you like to call it, that's still the same thing. The golden rule of trend is this: trade in the direction of the trend. Follow the market trend. Your trend is your friend. Are you getting me? How the trend trading works: identify the trend on the higher time frame, like the 1 hour, the 4 hour, or the daily time frame. Buy during pullbacks in an uptrend and sell during pullback in a downtrend. Are you getting me? Trend traders avoid fighting the market. Why trend trading is beginners friendly? Number one, clear direction, fewer false signals, less stress, and works well on higher time frame. Then most professional traders respect trend, and beginners should too. Support and resistance strategy. Support and resistance trading is based on a key price level. How the strategy works is this: support is price area where buyers is likely to step in, and resistance is a price area where sellers are likely to step in. The strategy is simple: buy near support and sell near resistance. Why this strategy works is this: market often respect historical price levels, also react repeatedly at the same zone. Now let's talk about support and resistance, because support and resistance represent market memory. The best way for beginner to use it is this: draw a clear zone, not an exact line. Combine with candlestick combination. Then also avoid trading every touch blindly. This strategy teaches you patience and discipline. Then let's talk about breakout trading. Breakout trading focuses on strong price movements. What is a breakout? A breakout happens when price breaks above resistance, when price breaks below support, and when price moves with strong momentum. This often occurs after a period of consolidation. How breakout trading works: one is identify a clear range or level. Wait for price to break with strength and enter in the direction of the breakout. Now let's talk about the risk of breakout trading. Number one is this: false breakout, high volatility, and emotional interest. Beginners should be careful and avoid over trading breakouts. Scalping. Let's talk about another type, another subtopic. Scalping versus day trading versus swing trading. Forex strategies also depend on trading style. If you don't know, number one is we have scalping. Who are scalpers? Scalpers involves very short trades, small profits, and many trades per day. It is not an ideal for beginners because it requires fast decision, involve high stress, and need strong discipline. Are you getting me? Then we have the trading. The trading means opening and closing trade the same day and not having an overnight risk position. Are you getting me? So it suits traders who have time to monitor charts, and also who can handle moderate stress. Then swing trading is best for beginners. Yes, it's best for beginners. Swing trading involves holding trade for days or weeks using high time frame. Why beginners should consider swing trading is this: 1. Less screen time, clearer setup, and fewer emotional decisions. Why beginners should keep strategies simple? One of the biggest beginners mistake is overcomplicating trading. Yes, common beginners error is this: using too many indicators, switching strategies consistently, and trading multiple styles at once, or copying advanced strategies too early. Complexity leads to confusion. Yes, complexity leads to confusion. Benefit of simple strategy is this: simple strategies are easy to follow. Simple strategies are easier to test and also reduce emotional trading. Or also helps in building consistency. Are you getting me? Professional traders often use a very simple system. Let's continue. How beginners should practice strategies. 1. Start in a demo account. 2. Trade one strategy only. 3. Use a high time frame. 4. Focus on execution, not profit. 5. Keep a trading journal. Mastery comes from repetition and not complexity. My final thought on this topic is this: Forex trading strategies are tools and not shortcuts. As a beginner, choose a simple strategy, understand why it works, practice patiently, and focus on risk management. Success in Forex is not all about many strategies you know, but how well you execute the one you have. Let's talk about the risk management in Forex trading, the most important skill every beginner must learn. Are you getting me? If there is one topic that determines whether a Forex trader succeeds or fail, it is risk management. Many beginners spend months learning strategies, indicators, and sharp patterns but still lose money. Why? Because they ignore or misunderstood risk management. Risk management is not optional. It is the foundation of long-term survival in forex trading. This section helps explain risk management in simple, practical terms. So anyone watching this video and reading this can be able to understand how to protect their money and trade responsibly. Are you getting me? Why most traders lose money? Yes. Before learning how to manage risk, it is important to understand why so many beginners fail. Common reason beginners lose money is this: most beginners lose money because they risk too much on one trade. They trade without a stop loss and they chase quick profit. They overtrade and they trade emotionally and they use excessive leverage. The biggest mistake is this: trying to make money fast instead of trying to stay in the game. Yes. The hard truth about Forex is this: Forex trading is not about winning every day or about winning every trade. It's about controlling losses. Yes. Even professional traders lose trade regularly, having losing weeks or months. Are you getting me? What keeps them profitable is this: how small their losses are compared to their winning. What risk management really means. Risk management is the process of controlling, yes, how much you can lose. 1. Protecting your trading capital. Then, the other one is staying emotionally disciplined. The goal is simple: never allow one trade or fewer trade to destroy your account. How much to risk per trade? This is one of the most important rules in forex trading. The 1% or 2% rule, beginner standard. Most professional traders risk one or less per trade. Some go up to 2% maximum. This means that if you have a $1,000 account, you risk only $10 or $20 per trade. Even with multiple losses, your account survives. Why? Small risk is powerful. Risking small amounts reduces emotional stress, allows room for mistakes, protects against bad tricks, and build discipline. Are you getting me? Big risk feels exciting, but it ends account quickly. Stop loss and take profit explained. Let me explain what is stop loss and what is take profit. Stop loss and take profit are risk management tools, not optional features. I understand. What is a stop loss? A stop loss is a preset price where your trade automatically closes to limit loss. It answers the question, how much am I willing to lose on this trade? Are you getting? Stop loss protects your capital. That is number one. It prevents emotional decisions. Number two. Number three, it keeps losses controlled. Then the other one is trading without a stop loss is one of the fastest way to lose money. Yes. Take this from this video. Trading without a stop loss is one of the fastest way to lose money. So what is a take profit? A take profit is a preset price where your trade automatically closes in profit. It helps to lock in gain, prevent greed, and maintain discipline. Together, stop loss and take profit define your trade before you enter. Risk to reward risk to reward ratio explains simply. Risk to reward ratio compares how much you risk, how much you aim to gain. Example of risk to reward is if you risk $10, aim to make $30, which is you are risking your risk to reward ratio is 1:3. This means that you can lose more trades than you win and still be profitable at the end of the day. Are you getting my point right now? So why is risk to reward ratio matters? Good risk to reward ratio reduces stress, reduces pressure to win every trade, improves long-term profitability, and encourages patience. Many beginners focus only on win rate. Professionals focus on risk to reward, protecting your trading capital. Your trading capital is your business fuel. Once it's gone, you're really out of the game. Golden rule of capital protection is this: never risk money you can't afford to lose. Avoid revenge trading. Don't increase loss size emotionally. Don't trade to cover losses. Take trade, take breaks after losses. Capital protection is more important than profit. Are you getting me? Then let's talk about this thing. Trading is a marathon and not a sprint. Like I always say in my videos, trading is a journey and not a destination. Trading is a journey that you continuously go and not a particular destination that just end. Are you getting me? Successful traders think in months, years, and hundreds of trades. Beginners often think in one trade, in one day, and in one lucky win. The mindset difference separates winners from losers. Common risk management mistakes beginners make, and also avoid this risk management mistake as a beginner. Number one, risking 10% to 50% per trade. Removing stop loss, increasing loss size after a loss, then trading multiple positions at once, and also ignoring drawdown. This mistake don't always fail immediately, but they always fail eventually. Simple risk management tools for beginners. If you remember if you remember nothing else from this video, remember this: risk 1% or less per trade. Always use stop loss. Always use a stop loss. Aim for at least 1:2 risk to reward ratio. Trade fewer or higher quality setup and protect your capital first before profit that comes second. My final thought on this: risk management is not about fear, it is about control. You don't need the best strategy, you don't need the most indicators, you don't need consistent win. What you need is discipline, patience, and strong risk management. A trader with average strategy and excellent risk management will outperform a trader with a great strategy and poor risk control. Common mistake beginners make in forex trading and how to avoid them. Forex trading can be exciting, potential for profit, the fast moving chart, and the sense of control can make beginners make it feel close fast. But here is the reality. Most beginners lose money not because the money is too hard, but because they make avoidable mistakes. Understanding this mistake is essential for long-term success. This guide explains the most common errors beginners make and gives practical tips to avoid them. Number one is overtrading. Yes. What is overtrading? Overtrading happens when traders take too many trades. Yes. It happens when you trade too often, and also it happens when you trade without a good setup. Overtrading often comes from boredom, impatience, or the feeling that I need to be in the market all the time. Why is overtrading dangerous? It increases risk of mistake. That is number one. It leads to emotional decision. Number two, it quickly depletes your account. Number three, and it reduces the quality of trades. Number four, how to avoid overtrading? Yes. One, stick to high quality trade setup. Number two, trade only when your plan signals entry. And number three, limit the number of trades you take per trade. And number four, take break if you feel impatient. Remember, fewer high quality trade beats many random trade. Are you getting me? Number two, trading without a plan. What is a trading plan? A trading plan is a set of rules for how you will trade, and it includes strategy to enter trade, risk management rules, your profit target and stop loss rule, and also time frame to trade. Why is trading without a plan fails? Without a plan, beginners often chase losses, jump in at random times, trade impulsively, and react emotionally to every market move. Are you getting me? This often leads to inconsistent results and account blowout. So how to trade with a plan? Write down your trading rules, follow your strategy consistently, review your trades regularly, adjust only after carefully analysis and not emotion. Yes, adjust only after careful analysis and not emotion. Number three, emotional trading, which is fear and greed. What is emotional trading? Emotional trading happens when decisions are based on feeling, not logic. The most common emotions are fear, exciting a trade, too early or avoiding trade altogether. Greed, holding a trade too long or risking too much for big wins. I get my point. Why emotions hurt traders? Fear and greed could fear and greed cloud judgment. Yes, these are the reasons why emotions hurt traders. Fear and greed cloud judgment. They lead to inconsistent risk management, and they often cause revenge trading after losses. Emotions amplify mistakes. How to control emotions? One, use stop loss and take profit to automate decisions. Follow your trading plan strictly. Take break after losses or stressful session. And also start with small risk per trade to reduce emotional pressure. Using too much leverage. What is leverage? Leverage allows you to control more money than you can actually have. For example, 1:100 leverage lets you to control $10,000 with only $100. Are you getting me? Why excessive leverage is dangerous is this. It magnifies losses as well as profit. Are you getting me? It can also wipe out your account in a single bad trade. And also, it tempts beginners to overtrade. So here are the things you need to know on how to use leverage wisely. Number one, keep leverage low as a beginner, 1:10 or 1:20. Never risk more than 1 or 2% of your account per trade. Treat leverage as a tool and not a shortcut to profit. Number five, accepting quick profit. The reality about Forex profit is many beginners think Forex as a get rich quick scheme market. Every trade should make money. Consistency is less important than big win. The truth is this, Forex is a marathon and not a sprint. Let me continue again. Why expecting quick profit fails? 1. It leads to overtrading and high risk. 2. It encourages session losses. 3. Increases emotional trading. 4. Makes beginners vulnerable to scams. Then, how to avoid these mental traps? Focus on consistent small gain. Prioritize learning over earning at first. Keep a trading journal and understand that losses are part of the game. Are you getting me? So, putting it all together, a checklist for beginners. To avoid these common mistakes, beginners should do this following. To avoid this common mistake, beginners should do this. 1. Follow a clear trading plan. Limit trades to higher quality setup. Use stop loss and take profit. Control your leverage and risk. Trade with discipline and not emotion. Also, focus on learning and consistency. My final thought on this is this. Most beginner loses in Forex. Yes, most beginner losses in Forex are avoidable. The mistake above are not caused by bad market but by bad habits. By controlling your emotions, trading with a plan, managing risk and keeping expectations realistic, you give yourself to the best chance to survive and succeed in the Forex. Remember, profitable Forex trading is 20% strategy and 80% discipline. Avoiding mistake is the first step to mastering both. Understand? Now let's talk about the next topic, which is creating a simple Forex trading plan, a step-by-step guide for beginners. If you want to succeed in Forex, there is one thing that separates consistent traders from those who fail, which is a solid trading plan. A trading plan is your roadmap for the market. It tells you when to enter trade, when to exit, and how much to risk. Removing emotion from the equation without a plan, even a good strategy can fail. This guide will walk you through everything you need to know to create a simple, effective trading as a beginner. What is a trading plan? A trading plan is a written rules and guideline for how you will trade. Think of it like a recipe for consistent results. A good trading plan includes your entry rule, when and why you enter a trade, your exit rule, when and why you close a trade, your risk rule, how much you are how much you risk and how you manage losses. Then your discipline rule, how you stick to the plan, because without a plan, trading becomes guessing and gambling. Your entry rule, when to enter a trade. Your entry rule defines the condition that you must be met before you place a trade. Yes. Example of entry rule for beginners is trend confirmation. Only trade in the direction of the main trend on 1 hour or 4 hour chart. Number 2 is support and resistance bonds. Buy near support and sell near resistance. Number 3 is candlestick for confirmation. Enter only after a bullish or bearish candlestick pattern forms. Number 4 is indicator confirmation, which is optional. Moving averages, crosses, or RSI level for extra confirmation. Are you getting me? Here is the key idea. Don't trade just because you feel like. Only trade when your conditions are met. Here are the exit rules. When to close a trade. Exit rules are just as important as entry rule. They tell you when to take profit or cut losses. Type of exit rule. Stop loss. Predefined price. Predefined price where the trade closes automatically to limit losses. Take profit. Predefined price to lock in profit. Trailing stop. Adjust stop as price moves in your favor to protect gain. Condition based exit. Close a trade if a trend breaks or a candlestick pattern reverses. Tip: always set your stop loss and take profit before entering a trade. Don't decide in the heat of the moment. Risk rule: how much to risk per trade. Risk rule protect your trading capital, which is more important than making profit. Simple risk management rule is this: risking 1 to 2% of your account per trade. Number 1, adjust loss size based on stop loss distance. Number 2, never risk money you can't afford to lose. Number 3, and avoid revenge trading after a loss. Yes. Example, if your account size is $1,000, risk per trade should be 1%, which is $10. If your stop loss is 50 pips, calculate the loss size so that a 50 pips loss equals to $10. Tip: consistent risk control keeps you in the game long enough to profit. Why discipline matters than strategy? Number 1, many beginners think that the key to success is finding perfect strategy. But the truth is this: discipline beats strategy every time. You can have the best strategy, but if you ignore your plan, you will lose. Trading discipline ensures you follow your rules, avoid emotional decision, accept losses without revenge trade, and trade only high quality setup. Are you getting me? Discipline transforms a simple trading plan into a consistent result. How to create a simple beginner trading plan step by step. Here are the step by step method you need to have to create a plan where you can actually follow. Number 1 is define your goals. What do you want to achieve? Example, consistent 2 to 5% monthly growth. Choose your time frame. Decide whether you want to trade on 1 hour, 4 hour or daily chart. Number 3, set your entry rule. What condition must be met before you enter a trade? Number 4, set your exit rule. When will you place stop loss and take profit? Number 5, set risk rules. How much will you risk per trade? Number 6, document everything. Write down your plan and follow it strictly. Number 7, review and adjust. Analyze your trade weekly and refine your plan if needed. Remember, start simple. Complexity often leads to confusion and emotional mistake. Here are examples of simple beginner trading plan. Here are the section and here are the rules. Your time frame should be 1 hour or 4 hour depending. Your trend filter, trade only in the direction of 50 exponential moving average. Your entry signal should be bounce off of support or resistance plus bullish or bearish candlestick. Your stop loss should be 20 pips or 50 pips depending on the market volatility. Then profit target should be 2x the stop loss distance. Then your risk per trade should be 1% of account per trade. And also maximum trade should be at least 2 per day. Then review, check your trade weekly and adjust rules if needed. My final thought on this is this: a trading plan is your safety net and guide in forex trading. Without a plan, trading becomes emotional. Risk sprayer out of control. Consistency is impossible. With a simple plan, you know exactly when to trade and when to stay out. You control risk, you build discipline and confidence. Pro tip is this: keep it simple, follow it consistently, and refine it gradually. Discipline will always beat complicated strategies. Are you getting me? Then let's talk about practice before going live. The practice before going live account. The essential step-by-step guide for forex traders. Forex trading can be exciting, but jumping straight into a live account without practice is one of the fastest way to lose money. Even experienced traders recommend demo trading before risking your real capital. This guide will explain why practicing matters, how long you should practice, how to track your trade, and how to know when you are ready to trade with real money. The importance of demo account. A demo account is a risk-free trading account funded with virtual money provided by a broker. Yes, you need to ask yourself why demo account is critical. Because it helps you to learn the platform. Demo account allows you to familiarize yourself with trading platform like MT4 or MT5. It helps you to learn how to place order like stop loss, take profit and monitor trades. Also, number 2, practice strategies safely. Demo account helps you to test your entry and exit strategies without risking real money. It also helps you to see what works and what doesn't work in real-time market condition. Then number 3, demo account helps you understand the market behavior. It helps you to get use of how market to get use of how the price move in different time frame and session. Also learn how news affect volatility and trend. Number 4, build confidence and discipline. Trading is emotional. Demo account allows you to practice following your plan without financial pressure. Then ask yourself, how long should you practice? There's no exact time frame, but most beginners benefit from at least 1 to 3 months of consistent demo trading before going live. Factors to consider. Number 1, consistency, because consistency are your trading regularly and not occasionally. Number 2, strategy mastery. Do your understanding and follow your trading strategy successfully. Number 3, risk management. Are you correctly using stop loss, take profits, and appropriate risk per trade? Number 4, emotional control. Can you stick to your plan even after consecutive losses? Then here is the tip. Don't rush into a live account just because your demo account is profitable. No. Profit in demo trading are not the same as live trading because real money triggers emotion that affect decision. Tracking your trades. Tracking trade is an essential part of practice. A trading journal helps you analyze performance and improve. What to include in your trading journal? Here are the things to include whenever you are trading in your trading journal. Number 1 is date and time of the trade, currency pair traded, trade type, whether it is a buy or sell, your entry and exit price, your stop loss and take profit level, your trade outcome, whether it is a win or a loss. You need to write it down. And also note why you entered, why you exited, and the lesson you learned. Why tracking your trade matters. Number 1, it helps you to identify mistakes and patterns in your trading. It helps you refine strategies. It helps you build discipline by holding you accountable. And also it helps you provide evidence of readiness in your live account. So knowing when you are really ready for a live account, even after months of demo trading, beginners should evaluate their readiness before risking real money. Ask yourself this question: am I consistently following my trading plan, or avoiding trading, or am I avoiding jump trading or changing strategies impulsively? Number 2, do I manage correctly on every trade? Risking 1 or 2% per trade, always using stop loss and take profits. Then also ask yourself the top question: am I emotionally prepared for losses? Can I accept losses without revenge trading? Then ask yourself this fourth question: am I patient and disciplined, waiting for the right time setup and not chasing for the market? If you can answer this question, all these questions, yes, then you are ready to open a live small account. Are you getting me? Let me now tell you tips for transitioning from demo to live trading. Number 1 is this: start small. Use a fraction of the money you can afford to lose. Keep risk low. Stick to 1 to 2% of risk per trade. Number 3, follow your plan strictly. Discipline is tested in a live account. Number 4, track trades in real money. Continue using your trade journal to learn from life experience. Number 5, be patient. Don't try to catch up for previous losses. Are you getting me? Now, my final thought on this is this: demo trading is not optional. It is an essential step to prepare for a forex market. It allows you to learn the platform, practice strategies, and build discipline. Without financial risk, tracking trades help you improve performance and avoid repeated mistakes. Only go live when you consistently follow your plan, manage risk properly, and can handle emotion. Remember, forex trading is a marathon and not a sprint. Practice first. Practicing first ensure you start the live trading journey with confidence, discipline, and skill to survive and grow in the market. Here is my advice for forex beginners. For those on how to start and stay on how to start smart and stay consistent. Congratulations! By this point, you have learned the basics of forex trading, how the market works, how to analyze charts, manage risk, develop a plan, and practice before going live. Before you start trading with real money, it is important to pause and reflect. Many beginners fail not because they do not understand how to trade, but because they approach forex with a wrong mindset. This final guide provides realistic advice, practical steps, and encouragement to help trade beginners succeed. So, what are the realistic expectations in trading? The biggest mistake beginners make is expecting instant wealth. What to know about forex profit is forex is not a get rich quick scheme. Even experienced traders lose trades regularly. Consistent profit takes time, practice, and discipline. Focus on small consistent gain instead of chasing huge wins. Example, a beginner account grows 2 to 5 a beginner account growing 2 to 5% per trade is already doing well. Slow and steady growth compound over time. Consistency over fast money. Consistency is the key to long-term success. Why consistency matters is protect your trading capital, build confidence and experience, prevent emotional mistake like revenge trading, and also allow compounding to work over time. Are you getting me? Even if your strategy is simple, trading this the same way consistently is more effective than trying to chase random big wins. Are you getting me? Here are the tips. Treat forex like a business, not gambling. Profit will come from repeated disciplined action, not luck. Then continuous learning. Forex is an ever-changing market. No trader ever stop learning. How to keep learning? Read forex books and blogs regularly. Follow financial news to understand market trend. Study charts and practice new strategies on a demo account. Learn from your mistake in a trading journal. Join forum or communities for insight and experience. Even top traders continuously refine strategies and learn new techniques. A mindset of continuous learning is essential. Final beginner tips and encouragement. Here are the practical tips to keep you in the right path. Number one, start small. Use a small amount of capital at first to reduce stress and risk. Number two, use proper risk management. Never risk more than 1 to 2% of your account per trade. Number three, follow your trading plan. Discipline-based strategy sticks to your plan. Number four, be patient. Profit don't happen overnight. Focus on learning and consistency. Number five, control emotions. Fear and greed are the biggest enemies of beginners. Let rules guide your decision. Number six, keep a trading journal. Track entries, exit, win, losses, and learn from those lessons. Are you getting me? Number seven, avoid overcomplication. Simple strategies executed consistently outperform complex systems that are rarely followed. Here are the encouragement for beginners. Forex trading is challenging, but it's also highly rewarding for disciplined learners. Remember, losses are part of the learning process. Your first trade may not be profitable. That's okay. Consistency, patience, and discipline are your greatest tools. Every trade is an opportunity to learn. Are you getting me? Success in Forex is not about luck, it is about preparation, practice, and persistence. My final thought is this. As a beginner, focus on setting realistic goals, following a simple trading plan, practicing discipline and risk management, and also learning continuously. With patience, careful practice, and disciplined mindset, you can navigate the Forex market successfully. Remember, Forex is a journey and not a sprint. It's a marathon. Each trade Each lesson and each discipline choose brings you closer to becoming a confident and consistent profitable forex trader. Be patient, use proper risk management, and always follow your rules. If you have watched this video up to this moment, please make sure to like this video, make sure to subscribe to my YouTube channel. Also, comment down below, ask me any question concerning any of my single video. If you have watched this video up to this moment, comment profitable trading. Follow these rules. If you can be able to follow this guide in this video, I promise you, you will start making money consistently. You might not be making that big money, but that consistent win, little wins, add up at the end of the day. Please, thank you for watching the video up to this moment. Take care, stay safe, love you guys, and I will see you on my next video episode. Bye for now.